What's up guys, it's Levi from Wall Street Survivor. Although in stock market investing, we usually focus on share price appreciation if we're buying and holding long-term stocks, today I want to talk about another way that investors can make money by buying and holding stocks. Today, I want to talk about another way that investors can make returns on their investments without necessarily relying on share appreciation. I've talked about dividend stocks in the past on this channel, but it's been a while, and since now we are officially in a bear market and in a recession, investors like you and me are looking for ways to still be able to fight inflation, protect our capital, or potentially even make money buying and holding stocks when it seems like there's a lot of volatility and uncertainty in the markets. So today we're going to talk a little bit about what dividend stocks are, why companies give dividends, and then I want to share 2 dividend investing strategies that have been commonly used by investors for years. As we're all rethinking our investments right now and potentially making adjustments to our portfolios, I hope this video can help add to your investor tool belt if you're potentially considering investing in dividend stocks. So first, what is a dividend stock? Well, certain companies, usually after they've been established for a while and are out of their immediate high growth phases, sometimes need a way to incentivize shareholders to keep their stock and keep investing with them other than just price appreciation of their shares. As you know, companies can choose what they want to do with their profits at the end of the year, and at the beginning, usually it's wise for companies to continue reinvesting in their company, whether it's creating new products, hiring people, or just expansion in general. But once companies have established a proven track record of profitability and their growth slows, sometimes they choose to take some of their profits and actually divide some of that up amongst their shareholders in the form of what we call dividends. So a dividend is essentially a share of the profit that you get awarded for being a shareholder of a company. A dividend is a separate payment from what you might receive whether a stock price goes up or down, and although companies change their dividend yields often, many companies, once they start paying dividends to shareholders, continue to do so for many, many years. Dividend investing is definitely not a get-rich strategy. It's definitely for long-term buy and hold investors. And while dividends can certainly boost your overall returns, even when the share prices are appreciating, a lot of the times the reasons that investors will choose to invest in dividend stocks is because they want some guaranteed amount of return, some safety or some protection, or some risk mitigation against downside risk. Certainly that's applicable right now, considering that we're in a bear market, the stock market is generally down for the year, and many individual stocks are suffering. So now that we've kind of reviewed why a company might choose to pay its shareholders a dividend and exactly what a dividend is, I want to share 2 strategies with you that you can use to pick out the best dividend stocks every year. The first strategy is called the Dogs of the Dow Strategy. And for beginners in dividend stock investing, it can be a pretty easy strategy to implement. First of all, in order to know what the Dogs of the Dow Strategy is, you have to know about the Dow Jones Industrial Average. The Dow, as it's commonly called, is one of the oldest stock market indexes, meaning it's just a collection of stocks. The Dow is a basket of 30 of the largest companies in the US. Many times, these companies have been around for many years, and most of the Dow stocks are usually considered blue chip, which means although they may be growing slowly, they have a proven track record of profitability, have been around a long time, and usually make good candidates for long-term investing. With the Dogs of the Dow Strategy, the pool of stocks that this strategy selects from are all within the Dow index. And like I said, since many of these companies are considered blue chips, they often pay dividends. So the Dogs of the Dow Strategy involves sitting down at the beginning of the year with the current stocks that are in the basket of 30 stocks included with the Dow Jones, and then usually picking about 10 of the highest dividend yielding stocks of that 30 collection. Typically, people will buy those 10 or so stocks at the beginning of the year and hold them throughout the year, as it's pretty safe to bet that the dividend yields won't change that much. And like I said, this is a longer term buy and hold strategy. And since most of the Dow stocks usually pay a dividend, the reason it's called the Dogs of the Dow Strategy is you might also pick stocks in the Dow that have recently suffered from a price decline. This strategy is effective for a few reasons. Like I said, the Dow stocks are usually considered blue chips, so if they have suffered a temporary price decline, it's more likely with these stocks than a lot of others that they'll regain their value because they have a history of being profitable and are reliable earners typically. Secondly, you'll get a steady stream of dividends from these companies, considering they have to announce their dividends ahead of time, and you'll know as an investor if these dividends do happen to change throughout the year. And third, If they do regain their price appreciation, plus you're getting paid dividends, it's a pretty safe way to sort of have the best of both worlds. Now, like I said, this isn't going to be a get-rich-quick strategy, and it is for long-term buy-and-hold investors. But when a lot of high-growth stocks are suffering, down 10, 20, 30, or even 50%, it may be attractive to consider some lower-risk, safer, more blue-chip options that also pay dividends outside of just their share appreciation. So that's the dogs of the Dow strategy. Sit down at the beginning of the year, pick the 10 highest dividend-yielding stocks out of the Dow index, or pick the 10 highest dividend stocks of the Dow stocks that have had a recent decline, hold for a year, and then reevaluate whether that strategy beat the S&P 500 or beat the Dow Industrial Average in general, and decide again next year if you'd like to do that. Obviously, you don't have to start at the beginning of the year. You can kind of start whenever you want, but if you're looking for a simple way to think about starting dividend investing, it's been a pretty proven strategy for the past couple years. From 2010 to 2020, the dogs of the Dow stocks outperformed the regular Dow index in 6 out of 10 years, tied and was only beaten by the Dow in 3 of the 10 years. This doesn't mean that's going to continue happening in the future necessarily, but in the past, it's generally beaten just holding all 30 of the Dow stocks in general. Okay, so that's strategy 1. Strategy number 2 for investing in dividend stocks is what's called picking out the dividend aristocrats. Dividend aristocrat stocks come from a larger pool of stocks called the S&P 500. The S&P 500 is another collection of stocks, but this time instead of 30, there's 500, and it's comprised of the 500 largest companies in the US. From there, in order to qualify as a dividend aristocrat, the dollar value of the dividends per share must not have decreased for any of the past 25 years. The idea here is that if the dollar value of a dividend per share hasn't decreased in the past 25 years, then it's less likely that the dividend per share dollar value will decrease while you're holding the stock. It doesn't guarantee it, but that's what qualifies as a dividend aristocrat. So right now there are currently 64 dividend aristocrats. That's 64 stocks that if you would have held for the past 25 years, the amount of dollars that you've received per share that you own would have not declined in any of those 25 years. From there, the dividend aristocrat strategy suggests picking a few of the dividend aristocrat stocks that have the current highest dividend yield. So of course, this is an informational only video and I'm not suggesting these stocks, but I will read you the current highest yielding dividend aristocrats. Right now, the top 5 are IBM with a dividend yield of 5%, which means that no matter what happens to that price, you'll be gaining 5% of the money that you invest in the form of a dividend. Number 2 is Walgreens. Number 3 is VF Corporation. Number 4 is Franklin Resources. And number 5 is 3M, the mask making company. All 5 of these stocks currently have a dividend yield somewhere between 4 and 5%. And so that means that no matter what happens in the share price, you'll be at least receiving 4 to 5% on the money you have invested as a shareholder of these stocks. So that's the dividend aristocrat strategy. I hope you guys found this video helpful, and that if you're considering investing in dividend stocks, you can add these 2 strategies to your investor tool belt. Make sure to drop a like on this video, comment down below what you think about these 2 strategies, and whether you're interested in dividend stocks, and as always, subscribe to the Wall Street Survivor channel, and I'll see you guys in the next video.